Good evening, everyone. Time for another silver update. This is the monthly chart of the US dollar Japanese yen. I'll go ahead and put up a MACD study on this. You can see that we've got very close to a breakout over the zero line on this. So this is a very, very long-term chart. It's provided by netdania.com. You can click on the link below. You can see that we have broken out of this very long-term trend line here. This actually goes back to 1981 or so. If you remember, the interest rate change in the United States had a very big impact on a lot of markets. And of course, that was the time when Volcker raised rates so high that it stopped the gold bull market. And we're going to come back and revisit that on other issues. But this is a very key chart because you can see that the Japanese yen has actually gone from a 300 plus number down to as low as 75. Now that amounts to a 75% devaluation of the dollar versus the Japanese yen, and you can see that we're going in the opposite direction now, and we seem to have a breakout above this line. So what does that portend? I don't know. Just to go to the history briefly, for those of you who are not familiar with it, the Plaza Accord was one of the key things that was involved with the change in the value of the yen versus the dollar. I'll read a little bit of this to explain it to you. The Plaza Accord or Plaza Agreement was an agreement between the governments of France, West Germany, Japan, the United States, the United Kingdom to depreciate the US dollar in relation to the Japanese yen and the German Deutschmark by intervening in currency markets. The five governments signed the accord on September 22nd, 1985 at the Plaza Hotel in New York City. So you can see this right here is the time frame where this was signed. You can see the dramatic devaluation of the dollar versus the yen. At that point, it really accelerated. In fact, later they had to rescind that in about 87, but it continued to accelerate until about 95 during the Clinton administration, where it reversed and then set a bottom that we've just recently tested. So now the reason I'm bringing this up is to show you that this intervention in the currency markets, this is a historic intervention because it was one of the first times that all the central banks got together and agreed to devalue. Now I'm not saying that this was an equal alliance. I think it was driven by the United States. But let's look at the result here. Here's the effects. Devaluing the dollar made U.S. exports cheaper to its trading partners, which in turn meant that other countries bought more American-made goods and services. The exchange rate value of the dollar versus the yen declined by 51% from 1985 to 1987. Most of this devaluation was due to the $10 billion spent by the participating central banks. Currency speculation caused the dollar to continue its fall after the end of the coordinated interventions. Now, what was the effect of this? You can see here the manufactured goods of the United States became more competitive in the export markets, but were still largely unable to succeed in the Japanese domestic market due to Japan's structural restrictions on imports. So you can delve deeper into this. There's a lot of articles on it, but the main point is that ultimately the Plaza Accord was a failure. Now, it was an attempt to bring down the U.S. trade deficit. We know that the trade deficit in the U.S. has grown larger and larger over the years, and it has not failed to grow continuously since even the mid-90s. So we're still stuck in the same quagmire, and of course the point being that central planners almost universally fail in their objectives because central planning simply doesn't work. So I wanted to show that to you. Now, the reason why that's important is because there's a battle going on. The euro is reaching new highs against the dollar. You can see that breakout there. And the only way to keep the dollar from collapsing, the dollar index from collapsing, of course, is to find another currency in the basket and cause that to go down at the same time. And you can see that's what's happening with the yen. So the yen is being rapidly devalued as the euro is gaining in value, and that is what allows the dollar to stay somewhat steady, although it appears that the dollar is forming a type of top here. You can see if we break down here, we may have a rapid decline in the dollar. Now over to silver, I posted a chart today that covered the reaction to the GDP number that came out. You can see that happened at about 8:30 Eastern time when the negative GDP number was printed. Of course, that simply means that the market was reacting to the stimulus that's going to have to follow on that news. And as I pointed out on my blog, if you saw the chart I posted, it's clear that there's been stealth inflation this whole time. And if you calculate in the stealth inflation that really is there, then one of the factors in GDP analysis is the inflation rate. Of course, it's understated, so that overstates the GDP. And it's my contention that actually the GDP numbers have probably been shrinking since the financial collapse began. So they're being masked by fake inflation numbers, and as those inflation numbers come in, we're going to see a reaction that's going to have to take place. We're going to look at that when we look at the interest rate story. Now, I wanted to jump over to the Silver Eagle story, but before I do that, I wanted to cover the new coin by Chris Duane. This is the Freedom Girl, and I have to say this one is by far my favorite from what Chris Duane has done so far. Don't really like the Slave Queen that much and the death. I like the message of the first coin, but I think this coin is really a fantastic design. I think that Chris is starting to hit his stride. I think he said he's going to do like 30 of these, and I think he had tremendous success with this one. I think he sold 20,000 on the first day. He mentioned that his site crashed or something. Now, that brings up the issue of the critics. I don't personally sell silver. I may think about trying to partner with Chris and release a coin on my own or something at some point. But the critics always contend that, well, obviously the reason why people are pumping silver is they just want to sell it. I don't think that Chris is making a lot of money on these, and I think he's trying to keep them tight as far as the volume to give them some collectability value. And of course, I don't begrudge him anything in doing this. I think he's doing a fantastic job, and I think the shills and the trolls and all the rest and the critics are dead wrong. I think that Chris has done exceptional work. He's put his money where his mouth is. He's acted. He hasn't just stood by and watched things pass him by. He's actually gotten out there and done things, and he's, in my opinion, very, very impressive person who's done a lot in this community. I just can't say enough about him. So let's get back to that Silver Eagle story, and that's on Silver Doctors. This is another site that I really am impressed with. I think that if you followed Silver Doctors over the course of the last couple years, he's really done a lot to improve his site. Of course, he's launched SD Bullion to compete with the other bullion sellers, and again, the critics are going to say, well, he just wants to sell silver. No, he believes in it, and he's putting his money where his mouth is. So, but let's look at this U.S. Mint story here. They've come back online and they're selling Silver Eagles. The figure we get from Silver Doctors is 7.42 million. Let's just call it 8 million. So I wanted to do some quick math before we get over to some questions, and I wanted to think about that in terms of the money that we're talking about from the Federal Reserve. So first of all, we want to calculate out that 7.42. Let's just call it 8 million, and we'll do that times the current price. So we'll do 8 million times the $32 and that gives us about $256 million that was spent to buy those Silver Eagles. So just as a comparison, let's calculate out the Bernanke money. So we know that Bernanke has promised to print about 85 billion, and that's a month. So we'll do a year, and that comes to about $1 trillion. So let's calculate the interest out on that. So let's multiply that times let's just say it's a 1% interest rate, and that gives us about $10 billion. So let's take that $10 billion and divide that by the number of days in a year, and you can see, well, I did it wrong. So we'll do 10 billion divided by the number of days in a year, and you can see we're looking at $27 million a day, or to get the month, we're talking about $821 million. So if you remember that $256 million figure that we had that was spent for the month of January on Silver Eagles, you can see that the interest, just at a 1% interest rate, the interest, and this is just on the new money that Bernanke has promised to print, is roughly 3 to 4 times that amount, 3 times that amount. So the interest on the new debt, not counting the old debt that the Fed is creating, every single day is 3 times the amount of money that people are spending on silver. So you can see from those numbers, the silver investment is still just a tiny, tiny drop in the bucket. It really isn't even anything, and it hasn't even ramped up yet. And of course, even where we are at, where it hasn't ramped up, you can see some bottlenecks forming. So we're talking about some very serious fireworks going forward in the future. So let's look at a question of the night. I'm just going to do one here, and this is about interest rates. Now, I did mention in a couple of previous videos that I have refinanced. I did close on that, and I have locked in below 4% on a 30-year loan. I don't know that interest rates are going up, but it seems to me, I just have a gut feeling that they very well could go up quite rapidly. Part of that, I think, is going to be connected to the debt ceiling debate. Of course, if they simply vote to lift the debt ceiling and not have it at all, then it really doesn't matter how fast that debt goes up, and it really doesn't matter if interest rates go up. So we could be looking at a 70 style move, and that's the heart of this question. Brother John, this does not require a video response, but was posted on January 1st. How do you feel the silver market will react when interest rates move up? I just read on King World News, they feel that will begin the market fall of the markets. Do you think money will still go into gold and silver, or would you tend to think that maybe what the shorts have been waiting for, and silver and gold will drop like a rock? Well, I can't say that what's happening today is analogous to what happened in the 1970s. I think the saying is, history doesn't repeat itself, but it is a mirror or an echo. And so if we go over and look at the 10-year note, this is the 10-year note. Let's go over to more and pull up the 30-year Treasury bond. And you can see I pointed this out many times before, that it is the biggest bull market in recent memory, going from 1981 to the present. And you can see we're pulling back. You can see that support line from the financial crisis. So there may be a bounce. But the key to this question is, will silver and gold go up as interest rates rise, if indeed interest rates begin to rise? Now, unfortunately, we do not have the 70s market, but if we did have it, you'd see it somewhere up in here from the mid-70s all the way down to this point here. We do have price information from about 77 or so, and you can see that we had a steadily rising interest rate. Now, if we go back to the gold chart, we'll just go ahead and use gold. You can see on the gold chart that we had a bottom in gold that was formed. It was much lower actually in the early 70s, but it formed a bottom in 76, and you can see this parabolic rise began. Now, this period from mid-1976 all the way to this Volcker top, we'll call it, actually was a time when interest rates were rising and the price of gold was rising. You can see the same thing on the silver chart. Starting in about 77 or so was when silver broke out. We know that interest rates rose all the way up until the very top. That's when they capped them up about 15 or 20% and crashed. The silver market ended up crashing a lot of things, the economy as well. But the point being that there have been times in history, and I expect there will be a time in the future when interest rates rise, continue to rise, and gold and silver prices rise along with them. Those are actually two things that can go together for quite some time. The reason being that the market is fighting inflation, and the inflation is reflected in people buying the precious metals, and it can just sort of feed upon itself. Now, the scenario that ended this move in the 70s was, as I said, the Volcker interest rate spike that we had, and a lot of people locked in interest rates as high as 15 to 20% on 30-year, 10-year notes and bonds. Do I think that can happen this time? Absolutely not. It cannot happen this time, and the reason why is because the national debt. If we even went back to 5% interest rates, if we had to fund our debt at 5% interest rates, we would be bankrupt. And so there would not be the ability to pay those interest rates from current tax revenues. Of course, they could print, but the problem would probably just get out of hand and just accelerate and rapidly spin out of control into hyperinflation. So whatever the scenario is going to be this time, it's going to be different in regards to the end and how it ends. But I do think it's going to be a parallel that when interest rates begin to rise, I actually think you're going to see a takeoff in the prices of gold and silver. And we'll go ahead and finish out with the silver chart in the Japanese yen, because we do have that breakout that is occurring where we're getting a crossover on the monthly. This is a real key because it's taken a long time to form. You can see on the monthly chart, the last time we had a cross, as I pointed out in other videos, monthly MACD crosses are very significant. You can see that we're verging on that cross if we haven't crossed already. The last one being all the way back in the early parts of the reflation of this economic bubble that we're in right now. So this is going to be a very critical point. You can see from the price there in Japanese yen that silver is actually testing what some would call the bubble areas. So it's coming back in and testing these areas. It's really testing an area that only had price action between roughly late 2010, early 2011, and then about through that May period. So really only a 5-month period where the price traded at that, and you can see we're strongly rallying into that and beginning to cross on this MACD. So it would not surprise me a bit to see an explosive up move to go back and test the high. Of course, in Japanese yen, that's going to be 4,000 yen. In American dollars, it's going to be $50, and I expect that that price will be tested, and then ultimately that it will be violated, and I expect to run probably to $75 when we finally make that breakthrough. And we'll talk to you next time.